Chris Shuba, Helios Quantitative Research, or just Helios for short. What's going on, my friend? How are you?
I'm doing well. I'm doing well. Just trying to make my way in the world right now. You know, it's the top of the year, so new year, new set of problems, new set of opportunities. You know how it is.
Well, hey man, I'm really stoked and appreciative of you joining us here on Bridging the Gap today. I'm interested to kind of get into asset management, investment management, as y'all call it. I think y'all call it ICO, CIO, or in-sourced CIO, and talk about what that means and how it's been built as a kind of a segment of our industry and a kind of a vertical. But before we do, I always like to learn about the people that are on the podcast. I think that's what makes this so much fun. So the way that I like to learn about people, maybe it's crazy, but I always just ask, what did the 13-year-old Chris Shuba want to do when he grew up?
13-year-old Chris Shuba. Let's see. I was living outside of New Orleans at that point in time. So pretty much probably the only thing I cared about was sports. I was probably thinking I was going to, like every kid, go somewhere with that, which clearly didn't happen. But, I always had an interest in actually what I'm doing now. I was always kind of a math kid, always kind of experimenting a little bit with like, what new information could I figure out if I, had a process. And so collected baseball cards. So yeah, in a weird way, the 13-year-old me wouldn't be super surprised about what I'm doing now, but I'm just much less famous of an athlete, I guess.
I think
or
you
not famous at all.
Yeah. many others, always thought, why wouldn't I be a professional baseball player? That's what I thought until junior year. And I realized sitting on the bench for 3 straight years doesn't make you a professional. So
it was the coach's fault. He just didn't see your talent.
Well, that's what I always said. I mean, that's what all the parents said. They just didn't quite see the talent. They couldn't see through the lack of talent there. But we're not going to go there. That's for my therapy session later today. I'm curious now, going from the 13-year-old Chris Shuba outside New Orleans, thinking going to go play professional, collecting baseball cards, checking the Beckett, and seeing how to trade them to make some money. How did the journey get to now being, CEO and co-founder of Helios? Walk us through that journey.
Sure. So, probably the best place to start the story is I was working within Ameriprise's corporate offices before 2008, and my world had always been a little bit on the analytics and math side of things, and post 2008. Ameriprise bought Columbia Threadneedle, or what was Columbia Management at the time, and they opened up a quant team. And so I think I was like employee number 3 or 4 on the quant team. And we started really doing a lot of cool, what I call quant 1.0 type of work, where you're, taking data, running it through basic systems like Excel and whatnot to find patterns, and of course using some advanced systems as well. But and along the way, I became friends with an advisor at the largest, at the time, Ameriprise practice. And he said, well, how do we take these quantitative capabilities that are locked away in big companies and make retail versions of these processes? And at the time, it really wasn't possible due to, cloud computing hadn't come along far enough and access to data. But by 2013, it was. So I left Columbia in end of 2013, beginning of 2014, and went to work at this practice and started building out, quant 1.0 capabilities within their space. And they were a big enough practice where they had an aura, and they said, other practices wanted to plug in, and Ameriprise Corporate wasn't going to have that, so it basically means I had to start Helios. And so, we grew mostly by word of mouth, and we evolved really from being here's a model or two, take it or leave it, to a full-blown in-source CIO that supports the entire breadth and width of all the asset management functions that need to go on inside a practice to create kind of that world-class asset management experience. And now that we've so fully gotten into AI, machine learning, neural networks, now we're even past that quant 1.0 world into quant 2.0, and I'm probably just making up words here at this point, but that's kind of how I categorize it in my brain. So,
well, I think that's extremely interesting. I think that it makes sense of given the advancements of the technologies. I guess I'm curious. I'm going to ask this as a layman, even though we all hear about quantitative research and quantitative investing and in quants as we call them in the industry, I guess, right? You are a quant. Is what is it? How do you explain it to someone? I mean, how is it different from just going out and kind of analyzing from a fundamental standpoint companies and deciding to invest in them? Talk to us about the difference there, if you could.
Sure. Some of it's splitting hairs. Like if you're following a mathematic process for determining the value of a company and you're doing that over and over again, that's quant, right? But some people might not consider it that way. What I really look at is that quant in its most basic form is taking lots of data and finding patterns in it. It's really what you're doing, right? And some patterns are very hard to reveal and you have to have complex algorithms to reveal them. And some are very straightforward, such as a moving average, right? So, quant, when it first came out, in the late, mid to late 2000s, and it was this rare thing that people didn't have access to. In the teens, it was, you have to get access to it through, a company like Helios. Now we're in a world where, Excel is powerful enough and data sets are readily available enough where anybody with above average Excel skills and access to data can be hired by a practice and you can deploy, quant 1.0, which is, you use, a process to look for patterns. And then you assume that those patterns are going to persist in their same type of fashion forever and averages out a better return structure than what you otherwise would do. That's both the power and the weakness of a quant 1.0 framework. So let me pause there because I talked.
Well, then let's make that jump now. Mm-hmm. So quant 1.0 is kind of there's all these different frameworks, statistical frameworks to find these patterns, mm-hmm. and then you jump now to the quant 2.0 where we have artificial intelligence and mm-hmm. neural networks. And how does that change the game? What does that now look like in terms of what quantitative investing looks like these days?
Yeah, it changes everything. It's such a vast topic where I'll kind of just pick a lane and take it, but just know that there's, so much more to get into. But for me, what Quant 2.0 represents is the ability to create a lot more consistency in the outcomes of quantitative processes. So if you look over the COVID era and you look at a lot of active quant strategies, they really struggled. And the reason by that is that patterns broke down. The long run correlations that quantitative processes are built on reversed. And the most easy to understand one is what happened with stocks and bonds. For 20 years, up until a couple of years ago, stocks and bonds were negative 0.5 correlated. It changed, but that's kind of where they were. Now they're positively 0.5 correlated. So if you built a process around fluctuating between stocks and bonds based upon volatility or trend or whatever you name it, the last 2 years weren't that great for you. Especially, in that scenario, maybe 2022 was particularly gnarly because you would jump out of the frying pan and into the fire. Now, the thing about quant is that you say, well, I'm going to find these patterns, these long run correlations, basically, and through good times and bad, I'm going to ride them. And some advisors, very few, are good at sticking to that. Most aren't. And so when you have a period like a couple year window, that grinds. You start to lose clients as an advisor, and it's hard to stick with, the eventuality of the fact that every model at some point in time is going to struggle, right? Mm-hmm. And there's a whole different rabbit hole that I can go down here, which is a personal opinion around, this is exactly the time where advisors now start to herd together and cluster. And now we're going to start seeing headlines again about fee compression and commoditization and all those different things, just like what we saw post 2008. But in any case, Quant 2.0 is a leap. And Quant 2.0 is a horrible name, but it's what I've been calling it. Where now you have AI and machine learning. What's really happening in this lane that I'm following, and again, this is a vast conversation, is if we know the weakness, or one of the weaknesses of Quant 1.0 is this dependency on patterns or long-run correlations, how do we use machine learning, neural networks to complement our long-run knowledge with a real-time analysis of what's going on right now? So that when conditions have changed to the point where these long-run correlations have broken down, how do we use real-time information to soften that eventual underperformance and maybe even turn it into outperformance? And as you add this ability, you're clearly improving the model. So therefore, your outcomes get more consistent over time. And of course, it's all in the design, and I'm oversimplifying, a lot. But the Quant 2.0 is really the marriage of all the things that we love about long-run correlations and pattern recognition, combined with the ability to take in new information as it exists right now, understand if there's a conflict, and learn from it.
So does it not, because like as I think about where I was kind of thinking through it, which I thought was super interesting, and you may be alluding to it, or maybe a different lane, is that the ability to say this is what the long term average was, now run it through a prediction model that goes further. And is that part of it, or is it just to be able to consume the current data and implement that so quickly to then use that information on the prediction? Is that in the similar lane, or is it different?
You're exactly right. So one of the deployments of a machine learning algorithm that we have, or set of algorithms, is we take these long run characteristics that exist by all these various asset classes, and we take that long run characteristic by how they behave over time. So they're patterns. And then we suck in all the data that's going on right now, millions and millions of data points, and use machine learning to understand, well, what of those millions of data points are actually moving markets right now? Now, how does that unique set of instances right now compare to what's happened historically? And what are the odds of that asset class, individual asset class, changing its behavior pattern, let's say over the next 30 days? Does that make sense?
Mm-hmm.
So you can't accurately take a long run 20-year pattern and apply it to the next 30 days or week or day or whatever it is, without understanding the conditions that are moving it now. And that is such a vast and complex data set that you need AI or something, machine. When I say AI, you're talking about a lot of different types of math. So you have to use some form of AI to do that quickly and with success. So you're right. It's exactly what you're doing. You're understanding the odds of a change, not necessarily predicting the future, which maybe I'm splitting hairs there, but you get the point.
Yeah. So, and this is a naive question, I think, but when you think about quant investing and now the access to data sources and the advancements of AI and the accessibility of AI and everything of that nature, is there a reversion? I know you're talking about how it was like a following of the herd of advisors, but is there a reversion to the mean of the benefit of quant investing at some point, because everybody has access to all the same models and all the same data and everything of that nature? Or where does that alpha always lie on the quant side, from that standpoint, relative to, I guess alternative ways?
Sure. So I'm going to parse this into two pieces. The first piece is there's a tendency, I think, for many folks to say things like everyone, but everyone doesn't always do the same thing. So even though there is this, sense of there's lots of different models and especially in the Quant 1.0 space, and they're all trend, they're all this, they're all that. You're right. There is an overlap. There is a amount of activity that exists because there is consistency among a lot of Quant 1.0 in the world. But that's a drop in the bucket relative to the whole of everything else everyone is doing all at the same time in different ways. Generally speaking, my experience is that if there is ever a trade that's powerful enough to be noticed, there's always going to be somebody on the other end hedging that trade or taking advantage of it to kind of wash it away a little bit. That being said, there's also all the different things that pummel markets as a whole that changes behavior sets of data. And that's why machine learning and things that can absorb data and learn from it are important, because the world is always changing. And that's a weakness of Quant 1.0, because it takes a long time for new data to become large enough as part of the data set to be used, if you will. Mm-hmm. So there will always be herding effects that go on, but in general, unless you're in a very small liquid pool, I've really just never seen any great studies that have shown that there's so much herding going on that the outcomes are dramatically different, I guess is the way I would say it. So, but a lot of that fear also goes away in the quant 2.0 world, because when you add in mathematic layers, which is effectively what 2.0 is, right? It's absorbing all of 1.0 and adding onto it. Now the range of possibilities gets a heck of a lot wider. So by widening out those mathematics, you get that. The second thing is that there's a massive skill gap between 1.0 and 2.0. So one of the things that we come across quite a bit in our seat at Helios is, we run across practices all the time that have hired a smart person that likes investing and has above average Excel skills, and they can go in and build, light versions of Quant 1.0 type models. And a lot of them, that's what they do. Quant 2.0 completely changes that game. The skill set of the person that would be required to run 2.0 type models are much more complex and vast than someone who's above average at Excel and likes investing. And I'm oversimplifying clearly, but that skill gap will also create a lot fewer players in the space, but the ones who do play will be larger to serve more advisors. So
the resources to be able to do it, because they'll be more on demand, it'll just become more costly. And so only the bigger players will be able to do it.
Well, I mean, another way to say it is just the costs of data alone to run a basic Quant 2.0 capability is an order of magnitude higher than what it would just cost to hire Helios, because we're a flat cost, we're a flat fee.
Right.
So why? You know what I mean? There's no upside to it.
Yeah, to have your own. And so what is that? Because then I want to get into kind of what asset management looks like going forward. But what is the implementation? How does that look to the end client? Because you're serving advisors, so you're running these models. You're probably running similar models for multiple firms. How does it look to the end client that gets it? Are they seeing trades every day? Is it through a mutual fund structure? Is it through an ETF structure? How does that look?
Yeah, great question. So funny enough, everything we do here at Helios is custom. So no two advisors we support have the same models. They might rhyme with each other in a different way, but in terms of their underlying holdings or those types of things, they're all somehow different. When we begin working with an advisor, that's step one. We analyze their practice. We look at all the holdings they're already using, the models they're already using, their philosophy, their client story. And we build all of their model ecosystem around all that. So for most of the end clients, it just feels like a rebalance, because we're going to repurpose as many of the underlying mutual funds, ETFs, et cetera, as we can. So it just feels like a rebalance to them. Everything we do is typically white labeled through the advisor. So unless they tell the clients we exist, they don't know. But all the client does see is that they get a substantial upgrade in their ability and their advisor's ability to articulate their process and create accountability even through bad years on whether or not, a model or a portfolio is doing what it's supposed to do. And that's, the benefit of quantitative modeling. Does that make sense so far?
That makes sense. Yep. So I'm following it. So they're just seeing it. They're seeing all the holdings in the portfolio, and then you're pushing the trades through a connection. Or are you pushing trade ideas to the team, and the team has to go execute it? Or are you pushing the trades all the way through execution?
The advisor gets to choose. So we can have a flat fee relationship with our advisor that we have all the technology interface. The models are sitting there. When the models need to be traded on their system, we'll tell them, here's exactly the tickers and percentages based upon your custom models, and then they can upload that into their trading software and they can execute all the trades. And we do that at a flat fee. Or we can do everything that we do, build all their models, provide all of our ICIO services, and we'll handle all the trading for them if it's an RIA or a select group of independents, but mostly RIAs. We'll execute all the trading for them, but then at that point in time, we're not charging a flat fee to the advisor. We're charging a small amount of basis points relative to like what SMAs cost to the client. So whether you want us to behave as a low cost SMA with all the capabilities of an ICIO behind it, we can do it that way, and the advisor doesn't have to worry about execution. Or we can be a flat fee, low cost way of getting you and your team what you need, and then you execute. So we're flexible either way. Yeah.
Staying on this path of how asset management strategies to asset management, I feel that you're very close to it, so that's why I feel I can ask this question.
Mm-hmm.
I'm curious in your perspective of the future of asset management,
Mm-hmm.
in terms of the wealth management ecosystem, right? And I'm always stay more specific on the security side as opposed to is investment management so valuable and everything of that nature. It's still a core function of what we do,
Mm-hmm.
so I'm not going to go down that avenue. But when I look at it, you look at this trend that's happened in asset management, right? You had mutual funds that came about, then you had ETFs come about, and everybody got squeezed on fees on each of those. And now you have direct indexing coming about because of some advancements in technologies that have allowed for that. What is the next, in your perspective, the next iteration of asset management? I know that mutual funds and ETFs are still used, and they're still heavily used, but there's just another now iteration with direct indexing that's selling against the ability that you can even customize an ETF. It was first low cost ETFs could beat the regular mutual fund, and then you had now direct indexing. What is the next iteration in this world of investing, as people are always looking to find ways to add value in investment management on the investing side?
That's a good question. I haven't really thought about it too deeply, but my expectation is that the only major leaps that are going to come in the product wrappers are going to come in the form of either tax management, which I know that a lot of the direct indexing conversation is around, but also ETFs handle some of that, right? Mm-hmm. Or create some form of a new access that we don't currently have. To me, the perfect investment vehicle right now is still the ETF. I like direct indexing in certain scenarios, but it's been around forever, and I'm kind of shocked at the amount of publicity it's gotten for no real great reason. I've seen all the papers, and I love how in certain scenarios, the tax loss nature of it is great. There are literally zero end consumers that I'm aware of that want to look at a statement full of 7,000 individual stocks in their account. So it's a massive increase in complexity from the client end to try to drive some potentially big value on the tax end. And for certain clients, that's great, and absolutely. But I don't think direct indexing is ubiquitous enough or scalable enough or easy enough to understand to replace the position of the ETF right now, in my opinion. But again, I know somebody's listening to this that's very deep into direct indexing is going to argue with me, but that's just my opinion on it. Now, if there is what made the ETF amazing was its liquidity to break it into pieces, and if needed, and at the same point in time, more tax efficiency. Now, if an iteration beyond the ETF can be built to make it more tax efficient through new laws, or new access can be created through, being able to have pools connected to it that can allow for typically illiquid things to become liquid, and all those different things that can be connected, I think there's a lot of evolution that could happen within the ETF. But the big major leaps in terms of transparency, breaking it apart, cost. I mean, there's 2 basis point ETFs right now, 1 basis point ETF. I mean, I don't know. I really don't think that area is ripe for disruption. I think that legislation and tax opportunities that might come are certainly a combination of innovation in our industry plus, politics. So I don't know. I hadn't thought much about it. I'm just kind of riffing here a little bit, but that's how I'm reacting.
That's right. I mean, I think to your point on direct indexing, right? I don't think anybody really wants to. I've talked to many of those firms, and you're showing 600 positions. It reminds me of, that was always a selling point that I was, when someone came over from Morgan Stanley and had a SMA that had 500 equity positions for a $200,000 account. It was always an easy sell. It's like, you don't need this much. You can do all of this in a smaller way. And so I think it's a psychological aspect. And so then I'm curious from your standpoint, when you go and you're serving your advisors and you're looking at how you're doing for them, how do you judge success? Is it all performance based on how your models are performing, or does the ICIO kind of infrastructure create more value outside of just the model benefits from that standpoint, in your opinion, in the value that you drive for advisors?
Oh, 100%. I mean, look, you can't be in this industry and not be somewhat competitive and you want to drive good returns, right? But one of the things that we've spent a lot of time and energy on is an analysis tool we call our confidence circle. And the confidence circle backtests any unique combination of models that we customize for an advisor and show them exactly how they behave throughout time. And then that constantly updates so that through good times and bad, an advisor always knows if a model's on track or not. And that's critically important for the advisor from a compliance documentation perspective, but also from an advisor or from a client's perspective. Nobody likes to go through a period of underperformance. You know you're going to. So if we do, is it normal? Is it supposed to be doing this or not? So we take great lengths to certainly create as much outperformance as we can, but also normalize the idea that asset management is a journey and it's got its ups and downs. And how do you stay committed to a process when you go through those periods of time? That being said, we're interested in an advisor being able to deliver a world-class asset management experience to their clients. And that's a heck of a lot more than models. So we actually do 6 major pieces for our advisors. First and foremost, we do all the holdings analytics, mutual funds, ETFs, individual stocks. We have our whole confidence rating platform for that. We do the models like we've talked about. We help them build and design mathematically diverse portfolios so that they by our view, mathematically increase the odds of achieving the financial plan, which is ultimately what everybody wants. That comes from portfolio design if you have the right models. So those are hand in hand, and that's what we do too. We're actually making some big technology investments to help streamline how an advisor actually builds portfolios. We do all the communications. We build tons of content for our advisors. So they use it internally, they use it for social media, they use it in their client conversations. We build all their decks, presentations, everything they would use to make sure that they're communicating effectively. We do other compliance documentation for holdings, models, and portfolios. It's basically automated in our system so that, once a quarter, once a month, hit a few buttons and we've documented everything for you. And finally, we handle all the training and education of their team as they grow and expand. Mm-hmm. So those are the 6 major functions, if you will, outside of trading that an investment department would do. And like I said, they can have us for trading too. So it's kind of 6 plus. Depending upon the scenario. So our value to advisors is about them being able to deliver a world-class experience. And that takes a lot of things going. But yeah, the headliner, the one that everyone wants to talk about, is always model performance. And we'll never get away from that given the industry. So
yeah. And I mean, as an entrepreneur, especially also in this industry, and I'm always curious to ask entrepreneurs this question as they're building their business. What's the biggest challenge you're facing right now? What's the biggest hurdle for y'all?
Oh, by far and away, the biggest challenge that we face is that advisors are really, really busy. The good ones, you know what I mean? And for an advisor to take a moment and see something like Helios, which we don't really have any natural competitors. Nobody's running around talking about ICIOs or, and even the term OCIO is got a million different definitions to it. The worst thing every day that I hear is an advisor tells us, "Oh my God, I had no idea something like you existed." And I'm like, "Well, we've been emailing you for 5 years, or something. We've had a million booths that you've walked by, and just getting mind share to sit down, for 15 minutes, an hour, whatever it is, and think about their practice if they had a partner like Helios. That's the biggest challenge that we have by far. So
yeah. And I'm curious because one of the challenges that we faced when we were building our technology company, Benjamin, which was a workflow automation engine for financial advisors, was similar to that, right? It was a newer technology, a newer vertical, and advisors and even the operations team just didn't have the time. Mm-hmm. And so if there's that, one thing, and you don't need to make it like a straight sales pitch, but mm-hmm. I was always trying just to help them see the tangibility of the value and the simplicity of getting it running. But they just say, "Well, I just don't have enough time," because that's an easy easy out. So what's that one thing that you wish that people would just say, gosh, I know Helios. I mean, this is why I just need to take that 5 minutes or 10 minutes. What would be that statement that you could use for advisors to say that would get them to see the light?
I'm a very what's in it for me kind of person in these conversations. Whenever, I think that most folks are gonna intuit anything new that they come across as saying, what do I get out of this, right? And that might seem harsh, but I think that's how most people operate. We built Helios to do three things at its end result. So if an advisor hears these three things, and even one of them is resonating, we should have a conversation, right? Because even if Helios is a little bit of work to explore and takes a couple of minutes to implement us, if they get these things at the end, it's worth it, right? And so we built ourselves around three principles. Number one, we want advisors to focus on their highest and best use. We want to take their workload down so they can maximize their time doing what they're best at, so their practice can grow, right? Number two, we built Helios to make them look good to their clients. Every advisor has one thing they care about, and that is that their clients like them. Our job is to put their value prop on steroids by typically taking a piece of the business that maybe isn't as strong as it could be and making that world-class. And then the last thing is we make advisors more profitable. We help them grow their business. In many cases, Helios is used as a way to generate revenue from us as opposed to being an expense. But certainly we create scale and efficiency. So if I talk to an advisor and they don't want to look good to their clients, they don't want to focus on what they do best, and they don't want to make more money, then I don't know what else to say at that point in time. But that's the net result of Helios. So if those are agenda items for 2024 for an advisor, what's the harm in a conversation? That's the way I
love that. I love that. All right, last question before we move to just some of the final wrap-up questions. I'll let you get back to doing the good work you're already doing. What AI is the theme. Everybody's talked about it. I was actually talking with a friend of mine who does a lot of writing. He's like, I'm tired of talking about AI. Everybody wants to write about AI. Yeah. But I mean, there's a lot there, right? There's a lot there. So I'm just curious from your standpoint, you're close to it. There's an impact that it's having directly on what you do day in and day out. What are you most excited about AI, one? And then two, do you see it to be here to stay, or is it just going to kind of fade off in the darkness and only impact a few small areas of our world?
Oh, the second one's so easy. Yeah. I mean, now that this genie's out of the bottle, there's, to use there's no putting the toothpaste back in the tube. Is that how you say it? Yeah. Yeah. There's no doubt that AI is here to stay. It's just too powerful to go away. It's not a gimmick, if that makes sense. That's the number one thing about it. So yeah, I'm not expecting it to go away. To your first question, I mean, what path would you want me to go down on that? I mean, like, I can go like 100 different directions, but is there like
go the most interesting path that you think most intriguing?
So I think the greatest opportunity for AI, and this is going to sound boring because it doesn't have that flash to it, but what it does is it allows us on our end Helios is a small company. We're bootstrapped. Everybody else in our world is a massive company or venture capital funded, and then there's Helios, right? And we have to be so smart about the way that we spend our resources in order to compete against bottomless piles of money. And what this does for us is, it used to be in the past that if I wanted to build a quant 1.0 algorithm, I would have to know the data sets that I want, acquire them, put my brain's theories or my team's theories against it, do it linearly in, Excel or Excel Plus type programs that could take days or weeks or months just to solve one test, only to have it be worthless. In the AI space, I can build a neural net with every piece of data that I have, ask it a question I'm trying to solve, and have it tell me exactly the process that might have taken me years to find or never. So for us, AI is the great hope of equalizing these vast companies with all these resources that can throw time at problems. And that's what's kept them in the lead in certain areas. And AI democratizes that for someone like me. So I'm super excited about those concepts, even if they don't sound as fun as like building a Terminator robot that can run around and, do jumping jacks. Like, I don't care about any of that. I care about scale, efficiency, knowledge that comes from those types of things. So boring answer.
I like the Terminator jumping jack answer. I'll go with that one. But I do, and I think that it does create opportunity, right? And it creates opportunity, creates innovation, and allows some really cool things to happen that may not have happened in large companies. So I can appreciate and I love that answer. So I'm gonna leave it there. But I have to get you to answer 2 questions I ask every guest on my podcast. And one of the main reasons I do this podcast is to first off deliver value to the listeners and insights that I think are unique and different. But it's also because I'm a natural lifelong learner and thirst of curiosity and like to learn from people that are much smarter than me, and you being one of those. One of the ways I like to learn though is via reading books. Yeah. I don't know. Yeah, that's smart then. That means that's smarter than a lot. I always like to read books. So I always like to ask people on the podcast, what's one book out there that you think everybody should read, or if they've already read it, they should reread it?
I'm rereading Traction right now, which is the EOS operating model, which is something that we're adopting here at Helios. So it just happens to literally be on my desk right now. Here it is. And it's a reread. So that's just the answer. I did read a cool fiction novel that I think they're turning into a movie, that if you are kind of a math nerdy type of person, it's called Project Hail Mary. And I think Ryan Gosling is going to be starring in it if it actually gets built. But it's a sci-fi story, and in it they do a lot of just like math talk to solve problems. And if you like that thing, it's kind of fun, and it's a good read too. It's a very unique read. So if you're looking for some fiction, some sci-fi, check that one out.
Love that. That. Last question I have. We talked about a lot of stuff here, and I'm sure there's a lot that we didn't talk about. But I always like to leave the listeners with something actionable they can implement today or tomorrow to better themselves or better their business. From your perspective, what's one actionable insight that you hope to leave the listeners with today?
Oh, man. Well, if I'm talking about action, if you're an advisor, you should call us. But if it's but outside of that, the thing that I would say, and the thing I've always said for many years around investing, is that find a process you believe in and stick to it. If you want to maximize your chance of, increasing your compound rate, achieving your dreams, it's not going to come from bouncing between things. Everything will go through periods of good. Everything will go through periods of bad. But as long as you get behind the decision-making process through those good and bad times, you're not going to have the regret or the fear or the emotions that go with creating, bad decisions. So, if there's one ubiquitous thing, find something you believe in, find a way of looking at the world, find a way of valuing things, and use that over and over and over again. And, you're not going to have the greatest returns of anybody in the history of mankind. There's only one person who gets that, and I don't know who they are, but you'll get comfortably where you need to be. So that's my piece of advice.
Chris Shuba, you're the man. I really appreciate you joining us, and super interesting conversation. Super interesting what y'all are doing at Helios. I am enthralled and will continue to follow you, and I'm sure that others will want to continue to follow you and what y'all are doing at Helios. So what's the best way for everybody to stay in touch and get in touch, given that that's what you gave us the actual insight?
Yes. Self-serving, of course. No, you can Google Helios Quantitative Research. You can find us at www.heliosdriven.com. And we're not hard to find if you're looking for us. So,
all right. Well, keep doing the good work, my friend, and looking forward to seeing all the great things you do for advisors. Stay well, be well, and thanks again for joining us here on Bridging the Gap.
Thanks for having me. This was awesome.